Hey everybody, Mike DeAndre here. Hope you're doing well. Today is July 21st, 2022, after the close, and I wanted to just take a moment and share some observations that we're seeing in the marketplace as it relates to some potential green shoots in US equities. Before we do though, I want to share with you a enhancement to our website that some of you have taken advantage of. Um, if you swing over to the site and select the schedule tab, it's going to bring up a scheduling tab, if you will. And on there, there is a 20-minute Ask Anything option. So if you, a family member, a friend has a question about the markets, about their circumstance, about their situation, and when looking at equity markets, we're off the low, somewhere around probably 16.5%, but a pullback year to date of, or to start the year, of about 24% in equities. And even more troubling has been the start in the bond market, down at its worst about 13%, and has rebounded just a little bit. But if somebody is in their situation and they have some questions, use the link yourself. Feel free to share it if you like. And it's just a free 20-minute Ask Anything question session. They'll get an opportunity to take a look at my calendar, pick a time that's convenient for them, and we'll have a conversation, and hopefully we can help them or help you. So just wanted to make sure that you were aware of that. So let's get started. We're in a world where there has been still high inflation, rising interest rates, and there's still a war going on. So when we look at the war in Ukraine, we see what Google Trends here for the phrase Ukraine war. And around February, late February, that phrase was very, very popular. It was a lot of interest, obviously, with Russia invading another country, but that search term has really waned. And I don't know if you've noticed, the media coverage seems to have changed significantly and really dropped off. I know there's other issues going on in the country, and things are, we're obviously coming up on midterm elections, but the war kind of seems to be, as tragic as it is, being discounted in the news cycle. So, there's not a whole lot I wanted to say on the war, but I did want to touch base on it. Now, inflation is still elevated. We're looking here at headline inflation in orange and core inflation in blue. So headline is all components, core inflation is all components minus energy and food. And you can see core is still around 6%, headline around 9.1%. And that's a 41-year high, folks. So not a comfortable spot, not where we want to be, but that is where we are as of right now. Now, you may have been hearing in the news the phrase transitory inflation, and Janet Yellen and Chairman Powell have kind of expressed some regret in referring to this inflation cycle as transitory. But really, transitory is a function of how quickly, not if rates will, or not if inflation will pull back, but how quickly it's going to pull back. So they're looking at things like shelter, restaurants, hotels, and transportation, and the infamous other category as being sticky. Like once you've gotten a raise, in or once your rents go up, they typically don't come down, and so that remains a more persistent component of inflation. But things like energy, vehicle costs, food that you would purchase at home, not necessarily at a restaurant, that has more of a transitory component to it. So it's understandable that people have been saying, "Oh, this inflation is transitory, and this inflation is going to be sticky." But it's important that we kind of understand what they're referring to when they say that. And first of all, transitory simply means existing or lasting only for a short time. Now, when we're looking at this kind of inflation, it's already felt like a really long time. So I don't know if transitory was the best choice of words, but just to give you sort of an example in what they might mean by transitory, this is a chart of United States food inflation in orange, or excuse me, in blue, and it is headline inflation in orange. And so during the periods where the food inflation, the food specific inflation, is significantly higher than the headline inflation, then you could say that that rise in inflation is transitory. It's temporary, it's short term. It doesn't persist over the entire life of this example. So the areas shaded in green are high transitory inflation. The areas shaded in red are low transitory inflation in relation to food versus headline news. So transitory, you know, when you're going through it, it's never transitory enough. It's not changing enough. Maybe it was just a poor choice of words, but it is applied or referred often in conversations about inflation. I just wanted to touch base with you quickly on that. So let's now look at interest rates. Okay, so here is the Fed funds rate sitting at about a buck and a half, and it was a very, very low from early 2020. That date just seems to ring a bell, keeps coming back. And here we are in 2022, and we've had a couple rate hikes, and the market is pricing in another 75 basis point rate hike. The odds of that are about 70%. There's some whispers of a 100 basis point rate hike. I'm not necessarily expecting that, not because I'm, a great gambler, but usually the Fed gives a little bit of a wink before they come out. This number is going to be announced on the 27th. Usually there'd be some sort of leak or some information that's shared, like there was before the last raise, when they kind of stepped out of what was expected. So we can have high confidence, reasonable expectation that we're going to see another 75 basis point hike on the 27th. Let's look for a moment here at the 10-year yield. Okay, so this chart represents the interest that you'd be paid on buying a 10-year treasury note. And back in September of 1981, you'd be in the mid-teens, around 15%, and you'd get that interest rate, you'd get that interest for the next 10 years, and then your principal back. Now we're somewhere around 3%. But if we look a little bit more granularly and we zoom in a little bit, we can see here that we're sitting in this range. And a couple weeks ago, we got a really ugly inflation number. And if you were buying bonds and you were really terrified about inflation, you probably wouldn't be happy of only getting a 3% return for those 10 years if you really expect inflation to take off. And the rates have not. They are, what they could be telling us is that maybe rates are more concerned about a recession than they are with inflation right now. If rates begin to go sideways or pull back, that could be something that is helpful for equities. We need to keep an eye on this. If this thing breaks down, we get somewhere, I'm not suggesting we're going to get back here to 0.5 point, but we get to 2, 1.5. That could be a very good period of time for equity returns, should we see that be the next leg in the 10-year. So let's take a look at some domestic equity indices. We have here the NYSE composite, and you can see a bottom here in 16. We have the election. We have a couple of corrections here in 2018 with regard to the trade war with China, the COVID high, the COVID low, the exponential ramp after COVID, and then we're pulling back into an area where you might expect that this is the logical place for the NYSE to make a stand and reverse back up. Interesting, we see the same setup here in the value line geometric index, which is sort of like your average stock sitting in a similar posture. See the Russell 2000 in a position that it could very logically be expected to see a reversal of this downward trend in the market, and the NASDAQ 100, where we're seeing another opportunity for there to be a reversal in the market. And so this, coupled with even a broader view looking at growth stocks, when this is growth versus value, and so when the curve is running up, growth is in control. When it's pulling back, value's in control. 2011, we saw a little bit of a tug of war, and then value won that, but now growth looks like it may be, again, putting up a bit of a fight here. So all of this could be something we need to keep an eye on, as equities, as of about June 16th, have begun to put a foot in the ground and say, okay, we might have a reasonable shot at making a stand here. This foot in the ground, June 16th, right there, we see the trend in equities has been down for the year, pretty much starting January, the first trading day of the year. We have had a couple counter trend rallies. 6% here, 11%, 7% and 8%. This is as of a couple days ago. This has gone a little bit higher with the last 2 days action. We need to see some actual follow through. This posturing, these setups have happened, 4 more or 3 other times, and it would be really nice to see that there's some actual follow through in this move. Now, If you're familiar with the cinematic feature of city slickers and you know of Curly and they're just one thing, well, if you're bullish on US stocks, there's one thing to really keep an eye on, and that one thing is the US dollar. It's going to be very difficult for US stocks to have a persistent run without a pause or a bit of a retracement in the US dollar. So from 1985 to March 9th of 22, this has been the experience in falling dollar environments. So here we see the US dollar, the greenback, down for this period 18%. Or excuse me, it's down on average 18% in those falling dollar environments. But that in that environment, pretty much everyone else is making money. So US stocks, foreign stocks, big stocks, small stocks, commodities, gold, oil, bonds, you name it, they are positive in those falling dollar environments historically. Okay, again, going back to 1985. But in rising dollar environments, we can see with strong moves in the dollar, that story changes a little bit. Some of your developed international companies, gold, commodities, and bonds, they may take a pause. Crude oil is about flat. Emerging markets are about flat. And again, emerging markets are often very tied to commodities and energy anyway, so they often move in lockstep. But generally speaking, equities don't seem to mind. So in today's environment, which is the most important, this has been the historical experience, but today is kind of a different story. The dollar is very strong. Commodities and energy have been ripping. Now, not all necessarily, I'm not necessarily suggesting that the cause is the dollar. There's a lot of things going on and a lot of inputs that make the market what it is. But this strong dollar has just been a wrecking ball on equities in fixed income. And in gold, gold's down almost 8% in an environment where people are terrified of inflation, and yet gold priced in dollars is down just about 8%. So when looking at equity markets, especially since June 16th, there's been some good news. There's been some good movement, but to see that follow through, it might be a good idea to keep an eye on the dollar and what the dollar does to tell us if this is going to be persistent or if we could be in for another period of volatility to the downside. So thank you for watching. I hope this has been helpful. Please remember, hop on the schedule, put in a call if you'd like. I'd be glad to help in any way that I can. Have a wonderful rest of the week, and I look forward to chatting with you soon. Take care.